Welcome back to Ground Rules, where we unpack the stories behind the numbers and help you understand what's really driving South Africa's agricultural markets. This week, there's an interesting shift happening in the grain markets, all right? Investment funds are still net long in both maize and soybeans, but they are starting to behave very differently in the two markets. Soybeans are looking increasingly vulnerable, while maize continues to find support from strong global demand as well as the uncertainty around future production. So, what exactly is driving this divergence, and what could it mean for both international as well as the local South African grain prices? We are going to dive into it, but before that, I would love to say that Ground Rules and AMT have joined forces to make this trusted agricultural market information available in English. Follow AMT for the Afrikaans Market Edition and the Ground Rules for the English market updates, all supported by AMT's decades of trusted agricultural database and market insights. Now, let's start with where the markets are trading. White maize spot price declined to 3,397 Rand per ton, with the July 2027 contract easing to 3,744 Rand per ton. Yellow maize moved lower also, with the spot price at 3,429 Rand per ton, while the July 2027 contract declined to 3,690 Rand per ton. Soybean spot prices softened to 7,930 Rand per ton, with the May 2027 contract now at 7,712 Rand per ton. Sunflower seed moved in the opposite direction, increasing to 10,191 Rand per ton, while the May 2027 contract sits at 9,202 Rand per ton. Wheat came under much heavier pressure, with the spot price falling sharply to 5,940 Rand per ton, while the December contract is trading at 6,218 Rand per ton. Elsewhere in the market, we saw sorghum import parity landed in Durban, standing at 4,439 Rand per ton. The latest Randfontein export parity price for shelled Argentine groundnuts sits at 21,000 Rand per ton. Cotton prices declined to 11,170 Rand per ton this week. So, what are the funds telling us? This week, one of the most interesting developments has been fund positioning. Funds are still net long in both maize as well as soybeans. But when we look beneath the headline numbers, their behavior is beginning to diverge quite significantly. In maize, much of the recent support is coming from funds buying back short positions. In other words, they are becoming less negative on maize, but we're not yet seeing them aggressively adding large new long positions. Soybeans are showing almost the opposite pattern. Funds are reducing their long positions while simultaneously adding new short positions. That means speculative support in the soybean market has weakened noticeably over the past 2 weeks. And this is why we at Ground Rules as well as MT love to watch fund positioning, because it gives us an indication of where significant amounts of money is already being positioned. The important question then becomes, what would need to change for those funds to buy even more or suddenly to start selling? Because that's often where the really big price movements begin, right? Let's start with soybeans, because for me, this is currently the market carrying the greater short-term downside risk. The first factor is US weather. The local forecasts across important production regions have improved, reducing the risk of a major yield shock. That doesn't necessarily mean the United States is heading for a record soybean crop. But if the August weather remains favorable, the crop could still be very large. And that is probably one of the reasons that the funds are reducing long positions and building new short positions. The second is oil prices. Lower crude oil price place particular pressure on soybean oil and the biofuel market, which can then weigh on the broader soybean complex. Then we've got China. China is buying US soybeans, but at a slower pace than what the market had hoped. They may simply be waiting for more favorable prices, but Brazilian availability and processing margins are also influencing those decisions. The important point is Chinese buying is not yet giving the market a strong bullish demand signal. Now, looking over into our local soybeans, South African soybeans also look vulnerable. Depending on which contract and market you compare, local soybeans are currently trading at approximately 1,000 Rand per ton above Randfontein export parity. Now, that automatically doesn't mean prices need to fall by 1,000 Rand per ton. Local crushing as well as processing demand also plays a role in determining prices. But a premium that large is still a warning sign, particularly if the Rand remains strong. So, our short-term view is that soybean prices could still move lower if 1. US weather remains favorable, 2. Chinese buying stays slow, 3. Funds continue selling, 4. The Rand does not weaken. Of course, that view can change and can change very quickly. We could have poorer US weather, we could have stronger Chinese buying, we could have higher oil prices, or a weaker Rand. All could provide renewed support. And also, there's another important point to remember. Because funds are now building new short positions, any bullish surprise could trigger a sharp recovery as those positions are quickly covered. So this remains a market where volatility could move in both directions very quickly. Moving over to maize, a more positive picture. When we move across to maize, where the picture looks somewhat more constructive, right? We've got the hot and dry conditions during July, which did cause some damage to the US maize crop. However, most of that damage now appears to have been concentrated in either smaller or some marginal production areas. The major traditional maize producing states still look very good. If weather conditions remain favorable from here, the United States could still deliver a good large crop. But the crucial point is this: global maize demand is so strong that the market almost needs record production simply just to keep up. So following the damage already experienced during July, another record crop is looking less likely from the US. And that means even a large US harvest may not necessarily allow global stocks to rebuild completely or comfortably. If production comes in slightly below expectations, while exports or feed use and ethanol demand remain strong, the US balance sheet could remain relatively tight. That would provide meaningful support to international maize prices. It probably also explains why the funds are becoming less bearish on maize. But again, we are mainly seeing short positions being bought back rather than aggressive new long positions being added. For maize to make a sustained move higher, the market will probably need a new catalyst, and that could come from either stronger Chinese buying or increased European imports, a smaller US crop, or greater production risk emerging in either Brazil or Southern Africa. Going back to local land, the South African maize premium. We've been talking about this now for 2 weeks. Locally, the big question remains, what happens to South Africa's premium above deep sea export parity? We are currently trading around 400 Rand per ton above the calculated deep sea export price. So does the local market eventually have to fall all the way down to that level? My view remains no, or at least not the full distance, particularly when it comes to white maize. Over the past few months, South African maize has consistently traded around 300 to 500 Rand per ton above deep sea export parity. And despite that premium, we have already exported approximately 900,000 tons of maize. The target is to move closer to 4 million tons of maize exports for the marketing year, using a combination of deep sea exports and exports into African markets. The fact that exports have continued despite the premium shows us that local prices haven't needed to fall completely to deep sea export parity for grain to move. Now, why does next season matter? I think uncertainty around the upcoming South African production season is also helping to support this premium. If El Nino negatively affects production in South Africa and the broader Southern African region, demand for South African maize from neighboring countries could increase very quickly. That is particularly important for white maize. The deep sea export market is predominantly a yellow maize market, while many of South Africa's neighboring countries rely on white maize for human consumption. And when producers and traders become worried about the next harvest, they naturally become less willing to sell the current stocks at lower prices. That increases the value of available grain and could allow the local premium to persist for longer than some people actually expect. Of course, there are still downward risks. We could still see a larger US crop, weaker global demand, stronger rand, or a slower South African export. All could place renewed pressure on prices. But for now, maize looks stronger to me than soybeans. Global demand remains exceptionally strong. Another US record looks less likely, and domestic weather and inventory risks are providing some additional support. Now, let's briefly touch on wheat. Part of the geopolitical or war premium has moved out of the wheat market, which has contributed to lower prices. But the risk around export routes and production has not disappeared. If production in major exporting countries deteriorates later in the season, funds could move back into wheat very quickly. So there is still some upside potential looking into next year. But we'll probably need to see a clearer supply shock before the potential really translates into stronger prices. So what are this week's ground rules takeaway? Soybeans currently carry the greater short-term downside risk, while maize looks relatively stronger. Even a good US maize harvest may not be enough to comfortably rebuild global stocks because demand remains exceptionally strong. Soybeans, on the other hand, are facing a combination of more favorable US weather, slower than hoped for Chinese buying, lower oil prices, and increasingly bearish fund positioning. Locally, the big debate is still the premium we're carrying above deep sea export parity. And I'd like to hear your views. Does the uncertainty around South Africa's next crop and local stock position justify a premium of around 400 Rand per ton above deep sea export parity? Or do you think exports and international prices will eventually force the local market lower? Drop your views in the comments. These are exactly the kinds of discussions we would love to have here on Ground Rules, and we'd love to create with our participants. Because the market isn't only about today's price, it's about understanding where the money is positioned and where the demand is coming from and where production risks are building and what could possibly change in the story next week. Thank you so much for joining us for another Ground Rules Grain Market Update. Until next time, stay informed, stay curious, and remember, the best farming decisions always start with solid ground rules.